We begin and discuss accounts and ledger. Right? Accounts and ledger. First, we begin with what's a ledger. Simply, a collection of all accounts. A collection of all accounts. You just, and then you will also have a chart of accounts. In chart of accounts is simply the everyone, kindergarten, okay? Class begin. University, okay? Remember? So, if you have any kind of business, you go outside, take care of your business, and then come back, okay? So, the ledger includes all accounts, while the chart is simply a list. It just tells you 101 is this account, 106 is this account. So, in a chart, you have what's called account number and account name. Wait a few minutes so you finish all of your business, right? Yeah, just take care of your business outside. Account name is already some of the familiar stuff. Cash, account receivable, supplies, prepaid insurance, equipment. You also have some of the liabilities, account payable, maybe note payable, unearned revenue. What we also do is we add typically a number. And the number is just for help. It's just for reference. It makes things easy. When people talk in the accounting department and you can think about this university, you may have 100 accounts or 150 accounts, okay, or 200 accounts. And you may have 30 or 40 accountants. So when all accountants talk, they need precision. And the precision comes with the number, account 126. So, put 5,000 in 126 means in supplies, okay? So, sometimes accountants like to talk not in terms of the name of the account, but in terms of the number. Because the number is clear, they know what it is, they know what it means, and usually does not change, okay? It just makes things easy, clear, and precise. It's precision, okay? You may possibly have, when you have buildings, you may have 5 buildings, okay? So, you may have a separate account for different buildings or separate account for different things, so you can separate things. Okay, that's it. So, separate a little bit. Just a little bit. I mean, I'm trying to teach. Accounting is fairly difficult. It's difficult to teach. It's 10 times more difficult for you to study, okay? Typically, half the students in accounting typically fail. It's normal to fail. Success is usually, and passing is usually exception. Because the typical students don't study real hard. You know, they talk during class. They don't do the exercise. They don't do the homework. They're not meant to survive, okay? They usually just fail. Most people, you gotta understand, most often in life, fail, okay? They don't accomplish anything. They don't do anything. They live their lives in debt. They got problems at work. They got problems at home. Their lives is a constant failure, okay? Usually, between 5 and 8, 10 people usually are successful in life, okay? And you now, to a great degree, determine if you're going to fail or if you're going to succeed. And in the management class, we discuss. They say, oh yeah, my dad's got a hotel and a restaurant. I'm going to be okay. Yeah, while dad is running the business, right? We discussed this last time, right? But when dad gets to retire and the lazy son or daughter takes over the business, sometimes or oftentimes the business goes bankrupt real quick. And they lose everything, okay? And it's up to you if you're gonna fail in life or if you're gonna make something. And the makings of your life, well, were in high school, but are mainly in here. All right, so the ledger is the complete set of accounts with the actual account, with the document. This one is just a list. It just tells you account name, account number. The ledger's got for each account all the increases and all the decreases. So the ledger is the detail. Here is just a short list. And then you have another one, like revenues, rental expense, salaries expense. These are the so-called revenue accounts and expense accounts. These are the assets accounts, liability accounts, and the capital accounts. Also notice a few other things. First one, they like the color. They put in the asset accounts with a blue color. And the asset accounts are usually 100 accounts. Next, you got the other ones. These are the other accounts are like payables and stuff. You see account payable and all these. These are 200 accounts. And these are 300 accounts. So, unearned revenues are liabilities. So, asset accounts are 100, 200 the liability account, the capital account is 300. Then, you got here revenues, typically 400. And then I have a whole bunch of expenses, typically 600. So, by the first number, you can guess most likely it's an asset, liability, revenue, expense, or capital. All right. And finally, we get to the account. Each account has a name, the same as title. Account title will be cash, will be account receivable. And it will have two sides, debit side and credit side. This is where students and many get confused. Now pay attention, because if you don't understand what's debit, you're in trouble. Debit means left side, okay? Doesn't mean up and it doesn't mean down. It simply means left side. That's it. Debit is the word for left. And credit is the word for right, okay? So, what is a T account? It is a ledger account, okay? So, a ledger will have 20, 100, or 200 accounts. So, it is a ledger account and is a tool used to understand. So, it's a tool to make it easy to understand and easy to see. It's very easy to see. When you look at it, you know immediately what happens, okay? Easy to understand, easy to see of one or more transactions. So it's easy to visualize the transaction. And here you put in the debits, and here you put in the credits, and I'll be explaining now the debits and the credits. And that's what account is. It's called a T account because it's like a T here. And if it's a cash account, I can just write a simple one over here. You just do the T, you just write on top cash, and then you write the numbers on the left side, 10,000, 5,000, on the right side, 7,000. I'll be explaining these in a minute for all of them, what these mean. So, first, T account is simply a T like this. This is the letter T. It's got a title, it's got a left side, it's got a right side called debit and credit. And now we get to the meaning of debit and credit. For an asset like cash, debit means increase. So, if it's a cash, debit means, or left side means increase in the asset. Okay? So, when it's a plus sign, you make it a debit. Okay? That's how we all agree. So far we discussed when you receive 10,000 in cash, cash goes up. Okay? That's what we say. If cash goes up, it means debit. You remember it. It's just two types. For the assets, debit means go up. For liabilities, debit means go down. For equities, debit means goes down. That's it. So debit means go up for assets and going down for liabilities and equities. That's the interpretation. That's how we do it. So every time you have to ask yourself, is it going up or is it going down? If it's going up, is it an asset? It's a debit, or is it a liability? If it's a liability, it's a credit. Okay? So you remember this simple table. For asset, debit means up. Okay? So in this particular case, for the cash, because it's an asset, 10,000 mean up, 5,000 mean up, 7,000 means down. Okay? So this is, and we always have what is known in accounting, the double entry accounting system. Double entry means you enter it twice. Everything you enter two times. Once is a debit and once is a credit. And you will always have all debits equal all credits, which again I'll be explaining today and later next time. All right. Now, double entry accounting for equity. Equity is a little tricky because some of the equity goes up, some of the equity goes down. Okay? So let's give it a try and see. Remember, equity, the credit is going up. So when you have a revenue increases equity. And if revenue increases equity, this means credit. Credit is on the plus sign. So here you have revenue and the credit is increasing. So revenues will be recorded as credit when you increase. Okay? We will do, just like in chapter 1, about 10-15 examples for each one. Debit, credit, debit, credit, debit, credit. But it's very simple. If you have a revenue, you usually credit the revenue and the revenues will go up. When you have an expense, you will debit the expense and the expenses will go up, but the total equity will go down. Okay? So that's the tricky. So when you make an investment, equity goes up. So when you have investment, equity goes up, and equity goes up, you have credit. Okay? Now, when he or the owner is withdrawing, the withdrawal means that equity goes down. And equity goes down, you have, let's see, for owners, withdrawal. Now, for investment, you credit, it goes up. Here, you got a debit. So the withdrawal increases. The withdrawal will increase. And when I give you the examples, it becomes very, very, very simple. Okay? And they always match. There's always a credit and there's always a debit. Okay? And the easiest one is when you pair a debit and credit with a cash. Again, I'll be explaining all this. But right now, the equity is more confusing until we get to think of, is it increasing the equity or is it decreasing the equity? That's how you, well, it's the same thing for liability. It's the same thing for asset, for everything. You gotta say increasing or decreasing, and then you put the one side or the other. Okay. So, now we get to the concept of account balance. So, you got a T account, and at the end, you got a balance. So, what is the balance? The balance is the total difference between all debits and all credits is the total difference. In this particular case, let me show you. All debits is 15,000. So I put in 15,000. All credits are 7,000. And now the total balance of the account balance is 15,000 minus 7,000 is 8,000. Okay? So it's simply the sum of total debits minus the sum of total credits. And you put it on whichever side is the bigger number. If this is the bigger, if the debits are more, you put it on the debit side. If credits are more, you put it on the credit side. The easiest account always to think is cash because it's intuitive. So the debit side for cash is always positive, increase. So you receive investment by owner, okay? So it becomes debit, cash, 30,000. Oh, this will mean credit capital, 30,000, okay? That's why you always want to pair it up if you can with cash. So debit cash 30,000, debit credit capital 30,000. Next one, consulting services revenue. Oh, so cash revenue, okay, debit. On the other side is going to be revenue credit, okay? So you debit cash, you credit revenue with the same amount, okay? Here, collection of account receivable means debit cash, credit account receivable for that amount, okay? So, now, purchase of supplies. What does it mean, purchase of supplies? You pay for supplies, okay? So, purchase of supplies will be credit cash, and debit will be supply. So, debit supply, credit cash. Next one, purchase of equipment. When you purchase of equipment, you have credit cash. So, credit cash, debit equipment. So, it is easier always to begin thinking with cash. You get the cash right, and then on the other side you got the other thing, revenue, expense, equipment, whatever it is. So here you have credit cash, it's going to be debit supplies. Here you got credit cash, it's going to be debit equipment. Payment of rent, oh, very easy. Credit cash, it's going to be debit rent expense. Rent expense, okay? Rent expense. Here, payment of salary is going to be credit cash, it's going to be debit salary expense. Okay? That's how easy it is. To make it easy, you always begin, if you have cash, you always fix the cash and then the other one is on the other side. Payment of account payable. Here it becomes the same thing. Credit cash, debit account payable. Alright? Last one. Withdrawal by owner. Withdrawal by owner is credit, cash, debit, withdrawal. Now, if you go back to the previous screen, debit withdrawals, you will see that debit withdrawals will increase the withdrawals. Okay? So this is a different way to think. It is exactly the same. But it's easier to think in terms of cash. Okay? Easy. And then we go back to the process. Okay? So the process is you take the source document. From the source document, you go and you debit and credit the accounts. Okay? So you do record the transaction in the accounts. Okay? You then do in step 2, it's called double entry accounting. Explain the word double entry. Double entry means always debit and always credit at the same time. And double entry means that all debits must sum to all credits. So the sum of debits equals the sum of credits, okay? In a simple transaction, the debit equals the credit, okay? So, you apply double entry accounting in step number 2. So, you take the document, you analyze. When you analyze, you put the debit and you put the credit. You put the one account, it's coming in a few minutes. You put the one account, whichever the debit is, and you put the other account, the credit, okay? With numbers and examples in a minute. So, now you see visual source document, you see the T account, you see how from the T account you get the general journal, and I'll explain now exactly what a journal means. Journal is a document which contains all transactions, salaries, payment, cash, everything. Everything which happens over time. So the journal gives you all transactions, everything that happens, usually in time. June 1, June 2, June 3, June 5, June 7. So this is everything in one place. And then you move it to the ledger, meaning account by account by account. Okay? And that's when you do this, now it's a little confusing. But when you do 10 problems or 10 exercises in the homework, when we try to do 5 in class, you're going to see it's always the same. You'll always follow these steps, and that's going to be the example maybe next time, maybe today. So, you take a look at it and say, oh, this goes up, this goes down, or this is debit, this is credit. You put the debit, you put the credit. Double entry means must have a debit, must have a credit, okay? And total debit must equal total credit. And then you put it in account. You think of this account name cash, okay? And then we go other steps. Wow! End of chapter 2, that's not interesting. There's got to be other stuff.
Finish class.
Finish class? All right, finished. Next time we continue with journals and everything.